You need to add this stock to your watch list ASAP. It is establishing itself in a multi-trillion-dollar industry, and I'm willing to bet you may have actually used one of their products without even realizing it. Let's do it. My name is Matthew, and I'll just tell you the stock right off the bat. The stock we're talking about today is called Marqeta, ticker MQ. So make sure to subscribe because I'm always trying to find stocks before everyone else is talking about them. I would also really appreciate if you drop a like on the video because these videos do take a long time to research, record, and edit. Here's what we're going to cover in today's video. What they do, their total addressable market or TAM, liquidity, growth rates, and profitability or path to profitability if they're not yet profitable. And I also want to take a brief look at their valuation, at least get that started, and then any risky risks if I find any. Let's kick it off with Marketo, which is actually down nearly 27% since it IPO'd in June of this past year. Now, you've probably seen a ton of companies, banks, and payment providers all offer their own unique debit or credit card. Well, Marqeta is actually the business behind the scenes that helps them offer and build those unique credit cards, debit cards, and wallets, and other payment mechanisms. They have a pretty similar business model to Visa and MasterCard, where they make money by taking a small percentage of every transaction from customers on those cards, and they also have some software fees. However, they're not competitors to Visa and MasterCard. In fact, they're actually more like partners, and MasterCard even invested in Marqeta recently. Marqeta has helped make these cards for companies like Affirm, DoorDash, and even Uber's debit card. And I actually think I've used one of their debit cards before with DoorDash when I used to DoorDash a lot. You would use the Dasher card or the red card when a customer hadn't paid for the order yet, but you had to pay for it once you get there to pick up the food. So it's kind of cool to know that I've used a Marqeta product and I've seen a bunch of them before, but I never knew they were behind all of these different cards, and that's the fun with investing. They've also partnered with JP Morgan to create virtual credit cards for Apple Pay and Samsung Pay, which could be used immediately after signing up and being approved instead of having to wait for a physical card in the mail. So basically, a ton of these companies are launching their own credit and debit cards and wallets. Many of them are powered by this company, Marqeta. But credit and debit cards are not the entire story. They also help power Cash App's peer-to-peer payments, and they help Affirm and Klarna, which are two buy now, pay later companies, with their installment loans. So you remember when everyone was downloading Cash App to get their stimulus checks a lot faster? Well, that was powered by Marqeta. This is almost a double-edged sword though, because yes, it gave Marqeta their two largest ever months, but that also means their 2020 numbers are going to be really hard to compare against this year. We'll talk about that later. As far as TAM or total addressable market goes, Marqeta sees the global market for card payments to grow from today's already huge $45 trillion to $80 trillion by 2030, which is absolutely insane. In terms of liquidity, looking at their balance sheet, we see that current ratio is a whopping 10-to-1 ratio, or a 10, which means they have 10 times more current assets than they do current liabilities, and that tells us they are very financially secure for at least the next year. And much of those current assets are actually coming in the form of cash, likely from their recent IPO. Now, a current ratio as high as 10 could actually be seen as a red flag because management should be spending much of that cash on investments and growing the business rather than hoarding it for too long. But all things considered, this is actually a pretty strong balance sheet in my personal opinion. Looking at growth rate and profitability, we see they grew an astonishing 76% year over year to $122.2 million in revenue for their most recent quarter. So recent revenue growth looks good at first glance, but we'll get into projections and the bigger picture in a second because it's actually not what you'd think. And in terms of profitability, losses nearly 10x'd from a year ago, from a loss of $7 million in Q2 of 2020 to a loss of nearly $70 million in Q2 of 2021. Their net profit margin also dropped from negative 10% to negative 56%. Again, this is just a first glance type of video, so maybe this can be explained away, but for now, I don't see a path to near-term profitability for MQ from the research I've done so far. And to prove that, it says here that their significant jump in gross profit was offset by increases in employee-related costs. So it wasn't just some one-time expense that tanked their bottom line. This was because of management decisions and growth that will be here to stay in the following quarters. Now, I think this is important. With the current state of the market right now, a rise in interest rates or higher rates in general would punish high growth, high multiple, loss-making stocks. So ideally right now, if I'm going to invest in a growth stock, I'm looking for one of three scenarios. That would be a profitable growth stock, which would be ideal, or a growth stock that has a trajectory and clear path to near-term profitability, or lastly, a loss-making growth stock but trading at a very cheap valuation that I can't ignore. So since Marqeta is neither profitable nor does it look like they'll be profitable anytime soon, we need to take a look at their valuation to see if it's just too cheap not to buy. So to set the scene, and you always want to use multiples as a way to compare against their industry and peers, the average fintech enterprise value to trailing 12 months revenue, or EV to TTM revenue multiples from 2018 to 2020 have been steadily climbing. It's like the price to sales ratio, but the enterprise value, which is what EV stands for, takes into account cash and debt, whereas market cap and price to sales ratio does not. If we put Marqeta on this chart, it's trading at an EV to revenue of 25x. So it is way above the industry average here. But it's a high growth company. We should be looking at forward metrics because the growth is not about where we are now, but it's where we're going to be for growth stocks. So this is Marqeta's next 12 months EV to revenues. It's only slightly better at 19.47x. It's still pretty high and higher than the average 15x of the trailing 12 months revenues for the industry. But let's compare this to some of their actual peers. So this is a comps table that shows the forward EV to revenue of credit card and payment networks based on their 2022 projected revenues. Now keep in mind, this data is from Q1 of 2021. If we look at the mean and median, Marqeta still looks very expensive, trading at 19x compared to 9.5 and 9.1. However, looking specifically at MasterCard and Visa, both of which are trading at above 16x forward revenues, they start to look a lot more comparable to Marqeta. Now it's a question of, are we cherry picking data, multiples, and information to fit some sort of bullish narrative? Or are MasterCard and Visa also overvalued? Or did we just find undervalued plays in Discover and Amex? I think any way you twist it, Marqeta still looks a bit overvalued even after a 27% drop since their IPO. And because it is trading at a high multiple, you have to ask yourself, am I willing to pay that premium for this business? On one hand, their latest earnings report was riddled with very bullish updates. For example, they had been chosen by Google to power the launch of a digital card for Google Pay balance users. Net revenue for their buy now, pay later vertical jumped 350% year over year. They extended their agreement with buy now, pay later beast Affirm through January 2024, and they gained 2 new C-suite executives, one from AWS and one from Salesforce. And then on the other hand, there are definitely some risks to consider. The first one is fading growth. I told you we'd get back to their projected numbers. So coming off of a second quarter that just reported 122 million in revenue, they guided here for lower revenue in Q3 of 114 to 119 million. And as well, they also guided for lower profitability with lower adjusted EBITDA. Now, maybe this is a seasonal thing. Maybe Q3 is rough for their business, or there's a better explanation. But at first glance and on the research I've done so far, again, this is a first look video, it looks like what's supposed to be hyper growth company is actually slowing down quarter over quarter. Now, having their revenue growth rate and projections graphed out, we can now see the big picture and realize this is actually a multi-quarter drop in revenue growth year over year. This is not what you want to see if you're paying a high premium on a stock's valuation. And 2 other risks worth mentioning are their business model and revenue concentration risks. 96% of Marqeta's volume was settled by one bank, Sutton Bank, meaning without Sutton, their whole business would be in a world of pain until they can find a replacement to settle 96% of their payment volume. On the bright side, they're signed with Sutton through 2027, so I'd say it's not really a huge concern until then, and even then, why would Sutton turn away so much business? Now, revenue concentration risk is also in the cards for Marqeta. Square made up 70% of Marqeta's revenue in 2020, and it's great that they have such a flourishing relationship with them, but if they lose Square, they lose 70% of their revenue. Now, granted, it was an unusually active year for Square's Cash App, as previously mentioned, with the stimulus and the popularity of the app itself. Even 50%, however, is alarming revenue concentration. And their contract with Square expires in 2024, which will be a real moment of truth if Square renews or not, especially if Marqeta hasn't diversified its revenue by then. All in all, this stock simply seems too exciting and too involved in the multi-trillion-dollar opportunity of fintech, and I really like it. That is from a qualitative standpoint, but a high valuation, increasing losses, and a potentially slowing growth rate, at least in the near term, makes the stock a watch for me right now. That does not mean my opinion can't change to a buy within like the next quarter or even next week if I find more information, which of course I'll update you guys on. And if you want my real-time buys and sells, you can check out Investor Community down below. Subscribe.